Hello and welcome back, everyone. Thank you so much for joining me today. I have some rather concerning news about the banking system in the United States. The Federal Deposit Insurance Corporation, FDIC, has just released its quarterly report, and the findings are quite troubling. According to the latest FDIC report, unrealized losses on available-for-sale and held-to-maturity securities have increased by $39 billion, reaching a total of $57 billion in the first quarter alone. This rise in unrealized losses is primarily driven by higher mortgage rates, affecting residential mortgage-backed securities. Alarmingly, this marks the 9th consecutive quarter of unusually high unrealized losses since the Federal Reserve began raising interest rates in the first quarter of 2022. I want to emphasize that this trend has persisted for 9 straight quarters, not months. Unrealized losses are essentially losses that banks have not yet realized. They are sitting on the books, waiting for better times to avoid showing these losses on their income statements. You might wonder why this is such a big deal. Well, there are several reasons, and I'd like to walk you through them at a high level without delving too deeply into the details. Firstly, this situation implies that banks are likely to face liquidity issues moving forward. They may struggle to have enough available cash to meet their short-term obligations, such as deposit withdrawals, which is alarming news for everyone. Secondly, banks primarily make money through lending. Liquidity issues can hinder their ability to lend because regulators require them to set aside provisions for bad loans, known as reserves. These reserves are determined based on current delinquency rates, associated risks, and future forecasts. We can expect to see an increase in bank reserves when they report their second quarter financial results in July. Having adequate loan reserves is crucial. It ensures that banks can leverage their reserves against losses or cover large cash demands in unforeseen events, like a bank run. Unfortunately, we are not seeing sufficient reserves at the moment, which is bad news for all of us. As economic conditions worsen, banks now have smaller reserves than they did even a year ago. According to international banker, the Federal Deposit Insurance Corporation, FDIC, revealed that U.S. banks currently hold $140 in reserves for every dollar of delinquent commercial real estate loans. This is significantly lower than the $220 per dollar of delinquent loans recorded a year ago, and represents the lowest level in more than 7 years. If that's not a recipe for disaster, I don't know what is. Additionally, the FDIC has reported a decline in loan growth. The industry's year-over-year growth rate of 1.7% is the slowest since the third quarter of 2021 and has steadily declined over the past year. This slowdown is due to tighter lending standards, less optimistic forecasts, and consumers already burdened with household debt, making them less likely to qualify for new loans. This combination has led to the slowest loan growth rate since 2021, which is critical because lending is a primary revenue source for banks. The FDIC has also started to acknowledge issues with commercial real estate loans, signaling a significant problem on the horizon. This is a huge red flag that deserves attention. The FDIC's report states that asset quality metrics were generally favorable, though this seems to be a sugar-coated way of saying things aren't going well. More specifically, they noted significant deterioration in commercial real estate and credit card portfolios. This is a major red flag. The report was definitely sugar-coated, but material, in financial terms, means significant. High office vacancies have been driving down the price of commercial real estate. particularly for office buildings that are no longer fully occupied due to flexible work arrangements. With these properties sitting vacant or half vacant, landlords aren't getting the same cash flow as before, effectively losing money on real estate that nobody wants. The worst part is that these under-occupied buildings serve as collateral for mortgage loans. As their value declines, the loans become less secured according to lending compliance standards. This is a simplified explanation, but it highlights the issue, which is the primary purpose of this video. I have several videos on my channel about commercial real estate loans and their risks to the banking industry. Feel free to browse and take a look at those. One key point to emphasize is that the longer interest rates remain elevated, and with inflation persisting, that's likely, the more trouble we'll see in commercial real estate lending, leading to a larger impact on the financial sector, particularly the banking industry. According to International Banker, the average reserves of major banks, J.P. Morgan Chase, Bank of America, Wells Fargo, Citigroup, Goldman Sachs, and Morgan Stanley, have dropped from $1.60 to only $0.90 for every dollar of commercial real estate debt, where the borrower is at least 30 days late. This is alarming. Delinquent commercial real estate loans, which have tripled to $9.3 billion for these 6 major U.S. banks over the past year, now exceed the amount of reserves held to cover them. These banks do not have enough reserves to cover these bad loans, which could be hugely problematic if the loans default. In late March, S&P Global warned that regional lenders are at a high risk of asset quality erosion due to stresses related to commercial real estate loans. An increase in modified loans, where lenders make concessions to help borrowers, will also lead to a decline in asset quality. This is very bad news for the banking industry, particularly for mid-size regional lenders. These deteriorations are signs of things to come, with more stresses and failures expected over the coming months and years. If interest rates remain elevated and property values fail to recover, loan default rates might reach or even surpass the levels seen during the 2007-2009 global financial crisis. Depending on the magnitude of these defaults, the resulting stress on the banking sector could trigger a wave of lender failures. As you can see, even though we don't hear much about this in the media, major events are unfolding that will likely become increasingly obvious in the coming months as more quarterly reports are published and new data becomes available. Unfortunately, we might be facing something even more significant than the 2008 financial crisis. Thank you for watching. I hope this video was helpful and that you learned something from it. Please remember to like, subscribe, and share. It really helps out a lot. I'd love to have you back for my next video tomorrow. Enjoy the rest of your day and take care.